in general is happening outside, not specific investments happening out there, and going through that. So I'm gonna kind of jump around a little bit. Michael asked, is the shutdown in China a cover to support Russia? This would all be opinions. My opinion is not. It is because they are afraid of COVID, and maybe there's something else behind it. I just know that China needs us a lot more than we need them. So them shutting down and hurting the supply chain is hurting their economy a lot more than us. I'm not going to say anything more than that. If you listen to any of my webinars, I've told you China has a lot more demographic issues and economic issues than we have. The pandemic has ironically given us a place to rely less on China and more on other producers, as well as making things ourselves, or to countries that are much more friendly to the United States than China has been. So I don't know. I hope it's not a cover-up. I will say from a social perspective, social cycle, I am afraid of the Russia, China, Iran, North Korea axis, because they've constantly been anti-Western countries, and what's happening, with Russia and Ukraine could lead to a much bigger conflict. But we're ready for that. Expect the unexpected, have a plan. We're ready. We would just batten down the hatches and weather it out, and know that through every armed conflict, opportunities are created. And I'll leave it at that. Cody asks, what's the best and worst case scenario entering the midterm elections? One thing I'll say is midterms are always bad years for the stock market. I should say almost always. I don't want to use that absolute. It's because of the potential change in leadership in government, especially the midterm following a presidential election year, because when one party's had full control of Congress, oftentimes that control is pulled away and it can create volatility. Markets love gridlock. So I would say best case scenario is whether there's a filibuster or not, having gridlock, so one party can't run the show, is probably the best case scenario. Worst case scenario, I don't say this as a political opinion. I'm an independent, so I typically offend both sides. Worst case scenario from an economic perspective and an investing perspective would be a further strengthening of the Democratic majority to the point of they decide to get rid of the filibuster, because there was a lot of scary, from an investing perspective, tax and spending proposals out there that didn't go through because of the filibuster and because of Manchin and Semina. So if for whatever reason there is a blue wave in November, from an investing standpoint, that could be bad. From a political standpoint, I'll let everybody else kind of use their own opinions there, and I'll stay out of it and stick to investing. Phyllis asks, can the funds be withdrawn and used for real estate investing without getting taxed? I will say that depends. If it's a Roth IRA, you could technically take out your contributions, not your gains. There may be other tax loopholes available to you there. If it's a traditional IRA, most likely not. The only thing I'll add to that is, if you're considering investing in your home, in order to look at it on a comparable basis, you would need to add up all the money you spent putting into that home, whether it's your yard, your furniture, your drapes, all the taxes, everything else you spent on there. I understand a lot of people's homes have gone up in value, which is actually a nice thing, because we've had this nice big push in real estate, and now our homes are all worth a lot more. But from an investing standpoint, I don't consider your home an investment because of all the utility, which is an economic term for the value it creates to you personally, it can create, but also the expenses. We all know about what we make per hour. If you add up how many hours you put in, take that times the amount of money you make per hour, include that as an expense. I know, even though we bought our home here in Virginia in 2018 and it's gone up a stupid amount, with realtors knocking on our door asking us to sell it. If I added up how much money I put into that house just in my hours, we would not be ahead of the game. So home is a home. Real estate investing is a different story. Talk to your financial advisor about how that would be taxed, Phyllis. Justin is asking about investing. Are ETFs a better choice to minimize capital gains taxes after maxing out my TSP? TSP is a federal government retirement plan, so similar to 401k and the IRA. Generally speaking, yes, if it's a taxable account. It just depends on your time horizon and what you're trying to do for that. So Justin, if you don't have an advisor, contact us through our homepage and we can give you some free advice there to kind of get you going in the right direction. Number 10, inflation and the deficit is driving the cost of the dollar down. How does this affect the market? And I think we grouped in number 11 is this a good time to invest in precious metals? And the reason I did that is because I was on the radio here in Virginia last night, and it was kind of shocking as I got into it, and I said, if you were completely right about inflation a year ago, and then you opened up the textbook and said, high inflation investments, what should I do? And it said to buy gold. It said to go short the dollar, which means the dollar is going to go down in value. And if you want lower risk investment, buy treasury inflation protected securities or TIPS. You would have been down 10 to 12%, which is actually worse than the stock market. I don't know what's going on other than we have a whole bunch of people speculating and saying, I think this is going to happen, therefore I did this. So inflation was already priced into the markets in all of those asset classes. And now the Fed is finally fighting inflation with interest rates and pulling back quantitative easing. Those investments are actually going down in value. Michael, specifically on the dollar, and actually, let me see. I think I pulled up a chart. Specifically with gold, this first chart's a 5-year chart. So if you had bought gold just before the pandemic, I'm sorry, right after the pandemic, you're actually underwater. Over the last 20 years, you're all the way back to where you were at in 2010 with gold. And we've averaged about 2% inflation over that time. So gold has not even kept up with inflation. So I think that's important to understand, that we can't just use that blanket statement of, I think because we're running deficits, because we have inflation, because the dollar might become worth less, we should buy gold, or we should buy some other investment, we should buy real estate. Blanket statements like that just don't work. I will continue to say, and this is my opinion, but I base it on data. If you look at all the developed economies in the world, US, all of Europe, Japan, the United Kingdom, and even if you group China in there, they're still emerging, but if you group them in there, from a demographic standpoint, we are the best out there. If you look at all the innovations over the last 50 years, they've been born out of the United States. Innovation creates growth. China is really good at taking our innovations and copying them and putting them into something else. So I don't think the US dollar is going to not be the standard out there. I am fully expecting 20 years from now, stocks to be higher than they are today, because I fully expect the United States to continue to dominate what's out there. So I understand your concerns, Michael. We have high deficits, but they're not as high as everybody else. We have a demographic imbalance. It's not as bad as everybody else in the world. We are suffering because we don't innovate enough. We still innovate way more than anybody else. I am so confident that the United States is going to get there. And I think we have one more question, and then I am going to wrap it up, because it does kind of talk about innovation. Sandy had asked about tech stocks like Amazon, Nvidia, Microsoft, that she owns those. Should she get out at this time? I don't give individuals stock advice. We were just talking in our office about just the shocking repricing that we've seen in a lot of different securities out there. Like, for instance, Target has lost 25% of its value this morning, simply because the supply chain shortages are hurting them, higher costs are hurting them, and people aren't spending as much money. And I say, was that a surprise to anybody? I mean, I took a survey in our office and everybody said, yeah, no kidding. Yet these analysts who make hundreds of thousands of dollars a year are now taking 25% off the value of Target stock. And I'm by no means saying buy Target stock. I don't know if it's fairly valued or not. I'm just talking about the change that we've seen. So, I want to, again, I'm not giving individual stock advice, but I want to sum this up and kind of use Sandy's question to help keep things in perspective. I use stockcharts.com, and Amazon happens to be one of the charts I put in there, simply because we do have clients who own it on a buy and hold basis. If you look at Amazon, I don't know why they've lost so much, other than the COVID spending is hurting them, as well as they're dealing with some unionization stuff. But if you look at this, what's breathtaking to me is Amazon is all the way back to the same level it was at before the pandemic struck. Does that mean they were overvalued before the pandemic, or are they undervalued now? I don't know, but I do know that all of us use Amazon. Amazon is one of the great American success stories, but the market suddenly decided that everything it made over the last 2 years was not justified, and now they've taken it all the way back. What else did Sandy ask about? Microsoft. I think I have that on my list as well. And Microsoft, and I think I have to zoom out a little bit, actually. Let me go out just 2 years here and look at Microsoft. And Microsoft is now back to levels it was at in April 2021 and June 2021. Again, another great American success story. Most of us use Microsoft products. They're continuing to innovate. I don't know if it's a good value, if it's time to sell or not. I do know if it is overvalued and their earnings disappoint, the market can chop it off. And then Sandy asked about Nvidia. I don't think I have that chart, but see if I can get it real quick. If that's the right symbol. It is. So again, Nvidia is taking it all the way back to where it was at in June 2021. Maybe 2021's gains were overdone, maybe they weren't. The whole point is these are very innovative companies in the United States, and they went way up in value, probably way too much. Because remember, my number one axiom with investing is the stock market is a story of human emotions and overreactions in both directions. I said, if you followed my blog, 2021 was stupid. You looked at the meme stocks, AMC, GameStop, everybody else, Avis Rent-A-Car. The reason they went up was because other people were buying. AMC is a movie theater, but they went up 30% because they said they were buying a gold mine. I mean, it was stupid. So if Amazon, Nvidia, Microsoft, who are great American companies with, solid business plans, and from all accounts, I don't know how many of those products we use in our office, but we use them a lot. And I don't see us stopping. They probably got grouped in the stupidity of 2021. Prices are back to where they were at in the spring of 2021. If we are in a normal recessionary bear market, they'll probably go down more in value, Sandy. If that money needs to be used in the next 3 years, you probably shouldn't have it invested in those companies. If that money is needed in the next 3 years, you shouldn't have it in the stock market. So the question comes back to, what's your financial plan say? What's your investment objectives? What cash flow do you need from these accounts? And what's your personality like? If you only bought these stocks because they were going up in value, you shouldn't keep buying these stocks, especially if you need the money in the next 3 years. So I know this is probably the longest webinar we've ever done. I truly appreciate everybody hanging on for so long. If you take away one thing, it's everybody's opinion doesn't matter. What matters is the data. SCM has a data-driven approach that's, we're 30 years and counting since we've been around. I've been here for 25 of those years. There's no panic in our office. This has been an awful, awful year. And I hate that people are losing money. There's no panic. There's no guessing. We're doing our job. The portfolios are doing their job. If you're in a situation where you're uncomfortable, whether you are an SCM client or not, take our risk questionnaire. We need to talk about your time horizon. Is this money you need in 3 years, or this money you need in 30 years? There's a big difference on what you should do based on that. Are you going to live off of your investments in retirement, or do you have a pension and you don't even need your investments during retirement? That's a completely different conversation. So thank you to everybody, clients, advisors, people just checking us out. I truly appreciate all your time. I appreciate you tuning in. Stay tuned. Follow us on Facebook, YouTube, follow the blog. We're going to have updates. If things get crazy throughout the summer, we'll be here as often as possible. Even if they calm down, we'll be back here in a few months with another update. So thank you, everybody, and just stay safe.